Folks, thanks so much for joining us today. Very excited for the last breakout session here in column four. We have a great speaker today on one of the most important topics for every founder. I was a VC for multiple years before rejoining TechCrunch as managing editor. And one of the most exciting things for every founder is to get a term sheet from a VC. But then you get one of those term sheets, and what happens next? That's what we're here to talk about in this panel today. I'm excited to present Lior Zoria of Nixon Peabody. He leads the West Coast Emerging Companies practice on the West Coast. And we're going to talk about what VCs are looking for in a term sheet. This is towards the end of the day, so you've probably seen this in some of the other sessions. We do have Q&A coming up after Lior's presentation. So if you want to ask a question to our speaker, please use the Q&A function on Zoom and not the chat feature. But we'll start first with Lior's slides, where he'll talk about term sheets, and then we'll answer your questions.
Thank you for that introduction. I'm very excited to talk about the topic, what VCs want in a term sheet. Really the purpose today is to give you a navigational tool as you work through it. Again, my name is Lior Zoria. I'm a corporate securities partner at Nixon Peabody, which is a highly regarded East Coast-based firm that does a myriad of corporate work, including large acquisitions, mid-market acquisitions, fund formation, and obviously emerging company and venture capital work. I've done hundreds of financings, and including many venture capital financings, and I'm glad to be here at TechCrunch early stage. I was TechCrunch's, for some of you may know, is TechCrunch's lawyer through the sale to AOL, and always feel great coming back to the TechCrunch stage. It always feels a little bit like coming home. So that happened almost 10 years ago to the dot, 2010 when we sold AOL.
Fantastic.
Okay, so. So what we want to do today is kind of give you an awareness of this process, which is obviously very exciting for very exciting time for the company, and in part perhaps sort of our philosophy for a successful process and a successful outcome. The elements of this presentation, we obviously can't go into all the details of a term sheet. You'll have plenty of time to do that with your lawyer and your advisors. We want to give you a basic sense of what are the motivations that drive your investors, a few of the key terms, and then some common pitfalls, and then kind of circle back to the philosophy, which ultimately is one where we want to foster an informed and honest working relationship with your investors. Okay, so what drives VCs? Like my dad used to say, you know, everybody's got a boss, and VCs are no different. VCs have investors, they answer to those investors, and if they don't make great returns, they don't get to come back. So investors are driven by returns, and so they will obviously want to have the best terms for them in the term sheet. On the other hand, investors also love talking about their successes, love talking about their companies, really support them, and in many cases, also, especially if they were working, if they're in industry before, love to give back. And so there's a bit of a duality for when you're dealing with investors. It's fundamentally different than any other investor class. Okay. So what is a term sheet? So at a fundamental level, it's a non-binding blueprint of what the transaction is going to be. But in many ways, it's much more than that, because a term sheet really is a catalyst for the beginning of the business, the formal business relationship between you and the investor. So as you enter this process, you have to understand there is significant asymmetry between your knowledge as an entrepreneur and the knowledge and experience of the investor. Many investors have done hundreds, if not dozens, of transactions. They know this. They're represented by sophisticated counsel, as they should be. And so even though this is a very exciting time, very, in some cases gut wrenching, because you want the money, you want it now, and you want to get going, you got to take action to level the playing field. You got to lean on your advisors, understand the terms, and in particular, make sure that you jive well with an experienced lawyer who can really help you get through this. Someone who's been there, done that, really understands the landscape, understands how to navigate through the process, someone who's got your back, someone that you get along with, and ultimately somebody that you can rely on. So as you start the process, you want to be in a situation where you create a strong foundation for a positive business relationship. And there's a mindset, and you have to understand that investors and entrepreneurs do need each other. Investors need great returns, and entrepreneurs need cash to run their businesses. And so once you realize that there's the ability to create mutual respect, what are the things that you can do to foster and continue that respect? Have open lines of communication. You've been talking to your investor prior about the business. You should be able to continue calling your investor, calling, texting, whatever way you like reaching out to them. Make sure that you're able to do that through the process. You may not always agree with your investor, and that's okay. This gives you an opportunity, a bird's eye view as to how your investor is going to deal with those differences. And as you look into if there's sort of one takeaway from this entire presentation, is as you look into the term sheet, which ultimately, and try to understand it, it is the blueprint for the definitive documents which create the management, the blueprint for the management and financing of the company for years to come. This first VC investment in particular creates precedent for future investments. And in many cases, the terms that you agree to today in your first VC round become practically irreversible. So you got to take this very, very seriously, and you got to take it seriously at the term sheet phase. So now let's dive a little bit deeper. What are some of the common terms? And there's basically two areas. One is obviously economics. We'll talk about that in a minute. But then also there is shared governance. Before you had virtually complete control of the company, and that is no longer going to be the case. This is a game changer for you, because no longer, now there's a shared decision process, shared decision-making process. And in addition, the investor actually gets very specific rights as well, governance rights, and we'll get to those in a minute. This slide is a kind of a summary, so we're just going to jump right into the economics and the governance controls. First one is valuation, and everybody loves to talk about valuation. What did my buddy get, and what's market, and that sort of thing. The valuation really is a fairly complex process, and it's driven by a number of key drivers. The first one is your investor has seen lots of deals, and they have what we call pattern recognition. So they really understand where you sort of fit in the scheme of startups and what your valuation can be, and they have probably have a range of what the right valuation is. The next one is obviously if there's lots of interest in your company, you can drive lots of interest and create a market that will positively influence you just by virtue of the supply and demand, the forces of supply and demand. And finally, if you think you're a great negotiator, well, great, because that can have some impact as well. But again, remember, the venture investor has a range, and if you negotiate a little bit too much, you may alienate, create some alienation in that process. So keep that in mind for you folks that think of yourselves as great negotiators. The investment amount is the amount of money that you really need for your next milestone. It's the amount of money till the next financing, but it's a little bit more fluid than that. In particular, if you are able to increase the valuation, investors have certain models in terms of how the percentage ownership that they want in the company, and therefore, you can get more. You can, as the process unfolds, you actually can increase your investment amount. I always tell my companies that more capital is better. Particularly early on, you run through it much faster than you think you will, and you never know when tough times come, like we have, like the ones that we are in right now. It's always nice to have a little bit of a buffer. Pro rata rights. So investors like to double down on their winners, and sometimes sometimes invest even more. These rights are sort of part and parcel of the rights that investors have. Talk to investors about how they exercise their pro rata rights. Really important, because if they don't participate in the next rounds of financing, that creates a signaling, potentially a negative signaling effect to your next investors. And liquidation preferences. Really, these are critical provisions in the case of an exit. We'll talk about those in the pitfalls in just a little bit. Governance terms. So like we said, this is a game changer. Things are dramatically different. Probably didn't even hold board meetings. Now you are going to have board meetings. Your investor is going to join the board. In the first round, you may have, the team may continue to control the board, but in future rounds, the investors will become the majority owners of the business. So that is a difference, and you have to understand how to work with a board that truly has the control of the strategic direction of the company. The other item is the contractual veto rights that investors will receive as part of this process. And those are fundamentally in two buckets. The first one is around dilution of the investor's ownership, and the other is over management decisions. Dilution, for example, comes in the way of, in most transactions, an investor has a veto over your next round of financing, for example. In terms of management decisions, maybe you need a certain approval for expenses or expenditures or capital expenditures of a certain amount. So these come in many different flavors, and you've got to look at those carefully. Information rights. Now that your VC has invested or will be investing in the company, you do have the organization is going to go through a process where it becomes more professional. The information rights really is one of those aspects. The information rights are those you now have to produce, if you haven't already, produced financial statements, in some cases audited financial statements, certainly on an annual and a quarterly basis, but sometimes even more so on a monthly basis. Drag along rights, these are interested because in some cases, and this is a minority of cases, but some investors will want to have the ability to force an exit of the company. So again, pay attention to this. Again, this is in the minority of cases. So in terms of pitfalls, we're going to go through just a few, but again, this is giving you a flavor of some of the things to look out for. So let's just jump right into it. Pre-money and post-money, on its face, seems like a simple thing. Pre-money is the valuation that's been agreed to, and the post-money is that valuation plus the amount of money that the investor has put in. But you really need to understand that these calculations are not so simple, because there's other items that go into the mix. And so you really, really want to understand this. So for example, for a lot of you that pre-Series A, or you've got convertible debt and you've got safes, and they've got all kinds of conversion provisions, and or they've got different types of conversion provisions, and you have to understand how that affects your pre-money. How much of that convertible debt is going to, how will that convertible debt affect the percentage of or the dilution that you experience right off the bat before the new money comes in. Option pool, again, there are conversations about, sometimes you already have an option pool. Does the option pool dilute just the team, dilute the investors, or dilute the investors and the team? So you have to understand those. And those, sometimes you have conversations around the term sheet and the pool gets increased, and particularly when the pool gets increased from the originally agreed upon term, then you have to understand how that gets how that affects the pre-money and the post-money. And another example is if you want to bring additional investors. Many times the lead investors are fine with that, but then the question is, does that additional money dilute just the team, or does it also dilute the existing investors? And an example for that is, let's say you have a post money of 10. Every dollar that if you bring $2 million, a 2 million investment, you have a 20% dilution. But if it's 3 million, then is that 3 million a 30% dilution, or is it sort of on top of the 8 pre-money? So from a practical point of view, you really want to understand these elements, because they will have they will have an impact on your dilution. And so just understanding these will get you to ultimately the right dilution that you're looking for. Option pool calculations. So what is an option pool? It's essentially a slug of equity that, and most of you know this, it's a slug of equity that's supposed to get you to the next round. But again, you really want to understand how an option pool impacts your cap table. Options really aren't even part of your cap table until they get issued. So you can have a pool, and if you haven't issued a chunk of your options and you get to an exit, the proceeds in that exit are going to be different than what you agreed upon in the term sheet. So again, make sure that you understand how this works, and ultimately work with your advisors and your lawyer to figure out what the right size is for you. There are, for any given stage, there are sort of directional guidelines, but again, it's a case by case basis, and so spending some time on this can make a difference. Last one is the liquidation preference, and this is the key term in an exit. And so your investors get preferred stock, and this preferred stock get these liquidation preference that determine how proceeds get distributed at exit. And these rights can have a profound impact on the distribution of proceeds. In particular, if the investors receive what we call participating preferred, not only do they share with the common, but they also get their money back. And so in this first venture round, you want to pay very close attention to this, because remember, we talked about precedent. If you start stacking these liquidation preferences, particularly if they're participating preferred, you're going to have a profound impact on the ability to incentivize a team in an exit after 3 or 4 or however many rounds. So you want to, we all look for unicorn exits, but you really do have to be realistic, and you do have to plan ahead. So in terms of, so this is the last slide. This is about how you foster that great relationship from day one. And so what we wanted to do is kind of give you 3, what we think are 3 key principles, which we believe will work well for you. The first one, of course, is when you make these decisions, think about the long-term welfare of the company first. In our opinion, this is the golden rule. Again, we know that there's some anxiety, there's excitement, there's emotion. You want the money, you want to get going, but these terms really do have do impact your company on a go-forward basis. So really understand that decisions you make today will not just impact today or tomorrow or even a year from now, but your investors and you are going to be together for a long time. So think about that. We talked about open and clear communications. Understand, like we said, VCs have many choices, but once they deliver a term sheet, that means they've chosen you. They think highly of you, and you should do the same. Sometimes you've spent a lot of time with the VCs. Maybe you've known them for a year, but sometimes it hasn't been as long. Collect the data. Talk to your other entrepreneur friends. Talk to your advisors. Talk to your lawyer. Get the data. And then as you go through the process, again, get the data on these terms. The VCs certainly have a view on what the terms should look like. But if you have an honest and open process, they will certainly listen to you. Certainly will consider it when you take a stand and when you feel strongly about a particular position. Many times, depending on your investor, may or may not agree. But so that is lesson number 2. And third is focus on building the best team. Jim Collins said it best: get the right people on the bus. I think Steve Jobs said, your first 6 employees are the ones that will determine the team on a go-forward basis, and so those should be very carefully vetted. Your VC is no different. It is a marriage in a way, and you're going to work with your VC, and your VC can be your biggest supporter. They're well connected. They can bring a lot to the table, well beyond just money. So how do they handle differences when you go through this process? How do they handle the tough times, whether it's COVID or the company's running out of money, et cetera? What's their network like? And then you will get a sense for this. What some VCs really like to coach and give back, and how important is that? How important is that for you, particularly for first-time entrepreneurs? So Danny, that's it on the slides. Thank you for this was great. Really enjoyed it, and I look forward to answering some questions now.
Sure, thank you so much. That was great. Obviously, if you're in the audience and you have questions, please use the Q&A feature on Zoom. Don't use chat. We're taking them as we go. Leroy, I want to start with a simple question, which is, let's say you're a first-time founder. You struggled to fundraise. You talked to dozens of investors. You finally get that term sheet. It's not perfect. Your lawyer gives you a couple of terms that might be a little more dicey or a little bit maybe not as competitive as some other terms. Like, how do you balance negotiating some of the terms of the term sheet with the fact that you just spent 3 months fundraising and this is the only thing you've got?
Yeah, so I would say, if you've only raised for 3 months, consider yourself lucky. That's pretty good. My experience is it takes quite a bit longer. I think to the extent that you don't like the terms, again, you have to analyze all the facts and circumstances in that scenario. Again, if a VC is delivering a term sheet, then they, generally speaking, they've provided the general contours. Can you negotiate? Of course. Especially if you've had that open and honest communication that we've talked about. But it's going to be a non-starter to say, we want a valuation that's twice as high. So you have to recognize that. So you have to, again, with your advisors, with your counsel, you've got to pick your battles. And maybe sometimes if you don't feel good about it and you've got an opportunity for other kind of funding, maybe you're more angel funding at that point, you don't necessarily have to take your first term sheet. So bear that in mind. You always have a choice.
And coming along that line, when you're fundraising, One of the attendees of the audience asked, "How do you when should you actually hire an attorney? Like, when in the fundraising process you're talking to investors, like, what is the right time to start having that conversation to actually retain counsel and involve them in the fundraising process?"
Sure. I mean, my view is you should retain the lawyer as soon as possible. Many lawyers in the emerging company space will give you certainly some dispensation in terms of cost early on. And the reality is that the term sheet, once the term sheet is agreed to, 90+% of the economics ultimately that then get hashed out in the definitive documents are already set. So you get a lot of bang for the buck. You want to hire your attorney well before you start, negotiating the term sheet. In addition, your lawyer or your advisors in that process can help you maybe identify other potential investors that would help the process generally. So I don't think you need to really wait. And like I said, in many cases, there are the lawyers in this space. We understand that you don't necessarily can pay the rates right off the bat, and so we do work with most entrepreneurs to help them through the process.
And Leo, on that front, I mean, talking about just expenses, obviously, having worked with a lot of early stage founders, one of the big questions is, gee, I'm afraid to ask a question to my lawyer because obviously the questions are, expensive from a billable hours point of view. In some cases, they're just educational. What's sort of the balance there for seed investors who, it is their first time, they've got to learn how to, negotiate these terms, but it's really expensive sometimes to ask those critical strategic questions.
Yeah, I mean, I think this is in the penny wise, pound foolish, and maybe it's not penny wise. Maybe it's a little bit more, large firms like ourselves. Our rates are what they are. I think just we're talking about open, honest communication. Talk to us, and we will be able to provide you with a pretty good view as to what the costs will be leading to the term sheet, through the term sheet, and then through the round, and also have an understanding of payment terms. So it's not uncommon for us to have a situation where sometimes we depending on the situation, we do provide that dispensation to founders to manage those costs. Absolutely.
That's great. And let's talk about a seed fundraising. So Ian here asks, you mentioned participating preferred, assigned to be paying attention to, at least in terms of the economics. Ian here is curious, are there other terms that are sort of irreversible from the seed on that founders should be aware of?
Well, again, on the irreversible, many of these are, and there's a whole slew of them. But for example, if we're talking about board representation, maybe there's 2 or 3 founders. Once you're no longer on the board, it's very hard to come back on the board. So think about that, for example. So very common. Board structure off the bat is: do we have maybe we have 3 directors, maybe 2 are the common holders, and maybe 1 is the investor. Or if the investor is maybe a little bit more aggressive, it would be 1 founder, a mutual director, and the investor director, in which case one of the founders has to sort of step down. And so those are that's an example. Another one is these contractual veto rights the preferred have. Those, of course, once you have them in the documents, your next set of investors will see that document in the due diligence process and will know what you've agreed to. And so to the extent that you've agreed on a capital expenditure veto right, then you're likely to have that again. So it's a very good question.
Great. And let's talk about a specific situation. So Arvind here is asking, how do you sort of balance the interests of, say, your angel investors, some of whom may have invested on a convertible note, where they would own less with a higher valuation at the seed versus the new valuation for the seed investor who wants it lower. There's already tension sort of on that, quote unquote cap table. What would your advice be to an early stage founder trying to balance the two?
Well, that's a great question. I think it goes to sort of that first principle that we talked about, or what we call the key three, which is look at the long-term interest of the company. Your seed investors have already made the decision. You've cut whatever terms you have, and now you have a new investment coming in from your venture investor, and so you need to optimize on that. Again, depends on what the specifics are that you've agreed to with your seed investors. But again, you want to optimize on this round. And frankly, the seed investor should have negotiated, and there are obviously terms that will protect them in the venture round. So I think, again, just think about what's in the best interest. And the other is the second principle comes into play as well, which is the open communications. Talk to your seed investors and let them know what's coming down the pike. And usually, most people are very, unless there's unusual terms in the venture round, most investors are going to be very excited, or most of your seed investors are going to be very excited about the participation of a venture investor.
We have a bunch of questions on participating preferreds, which I've never said, I think, on any panel at TechCrunch. But let me ask it slightly different from how some folks wrote it in. When should founders start to think about the waterfall and sort of the exit analysis for their companies? So we talk about stack versus blended preferred shares, liquidation preferences, participating preferreds. All this terms end up just getting translated into numbers at some point when there's an exit. Should folks raising an angel round worry about that? Should it, if they're raising a seed, do they start to pay attention to that? Like when should you start to be doing that exit analysis?
Well, so there's two pieces to it. One is the analysis itself as it stands on its own 2 feet, given the round of investment that you're contemplating. And you can do that right away. I'm actually a math major, and so I really enjoy that and enjoy doing that, right off the bat. And founders, as far as I'm concerned, do it right away and really understand how it affects immediately what happens in an exit. I think actually doing that analysis, doing a spreadsheet, will also help you understand these terms, and will bring it down to sort of dollars and cents. The other thing that's very important is what we talked about a little bit, which is maybe what you do is, if you have these provisions, these certain liquidation preference provisions, you model out what the next round would look like with the same liquidation preference provisions in a reasonable scenario, or other scenarios. And then you really start getting a feel of how the waterfall, how these liquidation preferences affect the proceeds. And for me, it's actually a lot of fun. I love modeling. So, but I think for most entrepreneurs, especially tech folks, shouldn't be that difficult either. And obviously in unicorn exits, it's not an issue. But you got to be sanguine about this. And the reality is that most venture investors are not unicorn exits. The vast majority are not. And many are well below 9 figures. And so you really want to model this out. So after 2 or 3 rounds, you can really see what that looks like. And so I think, starting right away is not only is helpful for understanding how the proceed distribution works, but it will also help you understand the terms, because they do come in different flavors.
Great. And we have an audience question on letters of intent. So let's say you're fundraising a fundraising round, and a customer comes to you and says, hey, if you close this, we're in for a $500,000 purchase order. They give you a letter of intent. Does that give you negotiating leverage with VCs when you're negotiating a term sheet?
Well, your VC is gonna know about this, and presumably you've already told him that this purchase order is coming in, and that is already baked into the valuation that you've agreed to. Obviously, when you're talking about valuation, we talked about market dynamics. If things are changing dramatically before the term sheet is signed, then, which is quite rare actually, certainly in the early stages, then you should bring that up and talk about it. Once a term sheet is signed, which again then sets the blueprint for these financing documents and the management of the company, it's generally viewed as really bad form to go back and negotiate the valuation. That is going to have an impact on that, the marriage that we talked about, that trust between you and the investor. And in most cases, 95, 99, very high percentage of cases, when you receive a signed term sheet from an investor, a venture investor, particularly a mainline investor, your chances of closing are extremely high. So once you get that signed term sheet, it's almost like, now we just move to papering it, but it is, you have agreed to a deal. For all intents and purposes, you agreed to the deal at that point.
Great. And Alicia here has a question about option pool. So I'm going to take it in two ways. One is, how much do you communicate option pool allocations to early employees, other founders, other folks involved in the company? Is that something that you should have a conversation with the whole company, or is that sort of confidential to the board? And second, how do you structure a conversation around an option pool?
With the board?
The investors and
with the investor?
Yeah, with the investors.
Yeah. So why don't we start with the second part first? I think, like I said, there are, for a Series A round, we certainly have directionally, we know what the option pool should look like. But it really does depend on your company. Maybe you're a very highly leveraged operation. You don't need a lot of people, and so you don't really need a big pool. You don't need a 20% pool, right? Not that I'm suggesting 20% is the starting conversation in a Series A, but on the other hand, maybe you need a large organization, and so maybe a large pool does make sense. So you really have to. There are these sort of rules of thumb, but they do get adjusted to your facts and circumstances, and that's just. And you should be able to have that discussion in a very open way with your investors. Obviously, investors will want a larger pool because that protects dilution on a go-forward basis. But you should, if you want to make a case for a more rational pool, that's perfectly fine. I think as far as your employees, and obviously, I think it depends on the level of the individual in the organization. Obviously, if it's maybe not quite a co-founder, but an early employee, they need to understand exactly what the cap table looks like. I think with certainly C-level executives, they're going to be sophisticated. They're going to know, and they're going to demand to, and frankly, you want them to know what percentage of the company they have. I think as you kind of go down in terms of the, more to the rank and file, I think there it's really about, creating grant sizes that make sense. So generally, you want to be fair to again, going back to sort of rule number one, you look at the long-term interest of the company. Generally, you want to be fair to people in the same rank. But so it's gonna depend. But obviously, with sort of the key hires, there's no question you're gonna have to work through it. And it's really not almost about the option pool as much as it is about the specific negotiated option that they will get, or equity for that.
Great. Well, we are completely out of time, and unfortunately, we have another dozen questions to get through. So if you are looking to follow up, it's lzaria@nixonpeabody.com. Lior Zaria, thank you so much for joining us today and talking about term sheets.
Danny, thank you very much. And it was a pleasure to be here. So thank you.
Absolutely. Thank you so much.